Hello and welcome back to the City of London. The euro has moved past 135 against the US dollar as sentiment in the eurozone improves. I've been speaking with Craig Erlam from Alpari about the common currency and also NFP Friday and the latest US GDP numbers. We have lots to get through. We'll get to the US GDP data later, but I just want to focus on the euro first because it's moved above 135 for the first time since December 2011. The indicators seem to show that sentiment in the eurozone is really starting to improve.
Yeah, absolutely. I mean, if we take a look at the fundamentals, at the end of the year we had the Greek bailout signed off. We also saw that Spain formally requested the banking bailout. And we also had the single supervisory body, at least in theory, agreed amongst the European leaders. So we have actually seen significant strides here. And also on top of that, we've also got a pretty quiet year ahead of us now. We've got the Italian elections in February, but other than that, I think it's going to be relatively quiet in the lead up to the German elections in September. I mean, I think that's one of the reasons why all these things were agreed last year. I mean, all of them are quite sensitive amongst the public, and I don't think German politicians are really going to want to have too much negativity coming through the media in an election year. So I think from now till September it's going to remain pretty quiet, which is going to benefit the euro and also European stocks as we've seen recently.
So 135 as a level, is that going to turn into an important support? In your view, is it overbought?
I actually think it's pretty overbought at this stage. If you look at the oscillators, especially technically speaking, a lot of them are pointing to the fact that the pair's overbought. I think we're actually going to see it start to trade within a bit of a range, and I think we are going to see a slight pullback moving towards 130 to 132. I think any movement above here is going to be a significant move. Like I say, technically speaking, we've got the 200-week moving average, which is providing significant resistance around 135.20. So I think a break above here is going to be quite significant, and also just below here we did have an inverse head and shoulders, which suggests, again, technically speaking, that suggests that we should see a move towards 142 if we do see a break above this 135 level. So I think 135 at this moment in time is very significant. So it's going to take a break, it's going to take a close above this week to really prompt a move significantly higher.
Yeah. Let's focus on the US GDP figures. A really big surprise. The consensus was for growth of 1.1%. We actually got a negative figure. Why was that?
Well, you've got to look at towards the end of last year we had the presidential election, and historically in the lead up to a presidential election we tend to have an increase in government spending. If we take a look at the GDP figures from the past couple of elections, we've seen a significant difference between the third quarter GDP figure and the fourth quarter GDP figure. I think in the last one we went from minus 0.3% in the third quarter to minus 3.8% in the fourth quarter, and we've seen something similar now. It's not really a coincidence that final quarter before the presidential election we've seen such a difference in the figure compared to the fourth one. So I don't really think there's too much difference. And on top of that, on this occasion we also have fiscal cliff concerns, so that affects consumer spending among other things. So it's not really too much of a surprise, although not many really predicted a contraction figure at this stage.
Yeah, the interesting thing, we were talking as we were coming in, is that there's been no great market reaction. Say a year ago the market would be bouncing all over the place, but not so today.
No, I find that really strange actually, and that's not just in the euro dollar, that's across the dollar yen in cable charts as well. So it is quite strange that we haven't seen too much of a reaction to this. I think the fact that people were expecting that figure of around 1.1, it is a surprise that we saw the contraction figure instead, but I think people were really prepared for the worst in this. Like I say, we've seen it historically that the election does tend to impact these two GDP figures from the third quarter to fourth. So I think people were really prepared for the worst, so just chose to stay away really.
Another big data release for the week is NFP Friday. I'm wondering now if we could see a bad figure there, if there'd be a similar reaction with the jobless data now the US election's out of the way.
That's very possible. I mean, like you say, we've got less government spending, but we have seen an improvement in the non-farm payrolls over the past few months. There is we have got the idea that we've gone past the seasonal period now, so we could see an increase in unemployment, for example. We could see a reduction in these non-farm payrolls, but the ADP figure released today suggests otherwise. The ADP was close to 200,000, so that suggests otherwise. However, on the flip side of that, we have got to only look to last month's figure to see that missed by around 60,000 compared to the official first estimate, so we can't really pay too much attention to that in particular.
Well, that's all from London Direct for the moment. Goodbye for now.
Thank you.